Good morning and welcome to the Weekly Insights with John Plassard. Today, I will be focusing on US Treasury yields and answer 5 major questions. First question, why is the yield of the US 10 years rising so sharply? There are various answers to this question. The first one is that inflation expectations are growing. We see this particularly on the 5-year. Next, the prospect of future massive stimulus packages from the Biden administration is fueling fear of a worsening US federal deficit and Treasury insurance. To this, we can add that yields move violently every time the US Congress turns a particular color. In this case, blue with Democratic control of both houses and the Biden administration. Finally, how can we forget that the famous CTA, who typically ride market momentum, are pushing up Treasury yields thanks to the snowball effect? Second question, is the risk of inflation really that big? If we're betting on an increase in inflation this year, it is mainly at the level of base effect. In fact, the latter should become more pronounced towards the middle of the year in the energy sector and in the second part of the year in the service sector. Third question, at what level is the Treasury yield a risk for the equity market? This is obviously the question that everyone would like to have an answer to. A few years ago, Goldman Sachs was talking about 3.5%, but we did not start from the same base, and the S&P 500 was at 3,000 points. Mirabaud believes that the level that could start to worry investors today is 1.5%. which is not so far from the current level. For my part, I think that it is not much the exact figures that matters, because we are still close to historical lows, but the speed of the rise and its trend. Fourth question, what is the impact of higher Treasury returns on equities? It is common to say that rising government bonds yields cause investors to turn away from equities as they become more remunerative. However, the reality is more complex. In the previous experience of 2004 and 2018, the indices had evolved in a totally different way. The role of central banks has obviously changed in recent years. And last question, which sectors are concerned? S&P 500 industries can generally be categorized as cyclical, which outperform when rates rise, defensives underperform when rates rise, and secular, perform irrespective of rates. Defensive parts of the market, such as utility and household products, have a strong negative relationship with nominal 10-year US Treasury yields, with cyclical parts, such as bank and autos, have a strong positive relationship. For other parts of the market, such as technology, their growth profiles mean that changes in interest rate are unlikely to be a major driver of returns. For 4 of the 5 FANG stocks, more than 70% of the return since the February peak has been driven by earnings growth rather than valuation expansion. Thank you very much. Have a great week. Stay safe. Read my morning and, of course, keep on winning.